We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Gayed, Portfolio Manager and Publisher of the Lead Lag Report. Thanks for joining me today, Michael.
Yeah, always a pleasure. Appreciate it, Tom.
So for some context for our listeners on you, you've written 5 different white papers over the years, and you focus mainly on identifying indicators that inform your decision to be either risk on or risk off. So can you start by giving us an overview of this strategy and an idea of what some of these indicators are?
Yeah, no, and I'm glad we're starting off with that because I think when people say risk on, risk off, they think in terms of direction. Whenever you hear, on the financial media, the market's up, they say, oh, it's a strong risk on day, or the market's down now, it's a strong risk off day. The risk on, risk off to me is not about direction, right? It's about conditions that favor higher or lower volatility in the stock market. And from that standpoint, there are historical leading indicators that identify the conditions under which an accident, which is where high volatility tends to live, conditions are likely to occur. So the 5 different white papers basically document different ways of determining the weather when it comes to investing in terms of where volatility is likely to rise or fall. And the primary papers that document this basically relate to interest rate sensitivity. So when you go back to the early 1920s, when the utility sector is outperforming the broader stock market on a very short-term basis, historically, not my opinion, quantitatively, you tend to see stock market volatility rise afterwards with a lag. Historically, when you have very long duration treasuries outperforming intermediate, same idea. Historically, you tend to see higher risk conditions in the stock market. And when lumber is weak relative to gold, you see a similar dynamic. So whether it's utilities, treasuries, or lumber to gold, everything is in some way, shape, or form a leading indicator because they are sensitive to changes in the demand for money, interest rates, right, in some way, shape, or form. And because interest rates are what drive the entire capitalist system, and they will tend to move on those changes first. If the expectation is that the demand for money is going to fall and these indicators see it in advance, it would suggest liquidity is dropping, which is where you would expect to see higher volatility anyway. Right? So when you think about risk on, risk off, it's really about under what scenarios is liquidity likely to fall to create a higher volatility regime. And in those higher volatility regimes are when you tend to see the tail wag, the extreme declines occur.
Mm-hmm. So, Michael, when you're talking about these extreme moves in the market, tell us about how in mid-January of last year, the mutual fund using utilities and treasuries picked up that they were seeing the demand for money was about to fall and what action you took as a result.
Yeah, so the ATAC rotation mutual fund that I run goes risk on equities or risk off treasuries based on the behavior of utilities and treasuries, as you noted. And basically, it's tracking that short-term behavior of utilities and treasuries. If they're warning of a risk off condition, and again, condition is the key word, it positions fully into treasuries. Now, mid-January in 2020, the signals came in, utilities were strengthening, treasuries were strengthening. It was enough to force the mutual fund to be risk off in long duration treasury ETFs. The signals are evaluated every week, which means that every week the fund's holdings could completely change. But because every single rolling period, utilities and treasuries kept on saying to stay risk off into the COVID crash, the fund completely avoided the decline, right? So made money in that flight to safety trade, was performing as everything else was collapsing around it. But the same exact signal then flipped back to risk on March 31st, pretty much a week after the low. And of course, there were a few other false signals and rotations between then and the end of the year. But, that's why the mutual fund ended up 2020 up over 72%, not because it was in Bitcoin or Tesla or anything like that. It was because it did what it was supposed to do, positioning risk off in advance of the actual risk off events, based on these rules-based relationships. Now, some people will say, well, how in the world could utilities and treasuries anticipate COVID? Well, they weren't anticipating COVID. They were sensing some kind of drop in the demand for money. And maybe that was because of slowing growth expectations that were starting to take place anyway in January. Or maybe there was a feeling on the fringe that COVID could be a much more serious thing than people thought sitting back in January. People forget COVID was not like a surprise situation. Right? I mean, there were plenty of tweets back in November and December coming out of China that showed, people that were very, very sick, and there were rumblings about this sort of respiratory illness long before the March collapse happened. It could be that maybe utilities and treasuries sense that, interest rates sense that. Whatever the reason is, though, historically, more often than not, utilities and treasuries, and again, same deal with lumber relative to gold, they all tend to warn you in advance. The narrative and the reason for why is only known long after the fact, which is why I'm a big fan of rules-based approaches, because it's not about the narrative, it's about the signal, and then the narrative is what happens afterwards.
Mm-hmm. So you talk about utilities being one of the most boring sectors of the of investing, basically. So why is it so sensitive to changes, or why is it so sensitive to these changes, Michael?
So utilities are really a very unique sector from a few perspectives, right? One is highly regulated, at least here in the States, right? So, a utility company can't increase electricity bills by 30% in the following month. Just is not going to happen, right? I mean, you'd have people screaming at their local politicians saying, no way am I paying my electricity bill now. So they're very regulated from a revenue perspective in terms of how much they can charge the end consumer. And at the same time, they tend to be very highly levered companies, right? Especially the electricity utility companies, which have to kind of maintain their infrastructure to transmit all of that electricity into homes. So because you have this kind of double whammy of high leverage that has to be maintained and revenue that is fairly regulated, the bulk of earnings for utility companies doesn't really come from increased demand for utilities. It comes from the cost of capital, because it's about the sort of interest expense they would have to pay to keep on maintaining that debt load. So because of that, that's why utilities are historically the most bond-like sector of the stock market. Right? And it's why they tend to behave the most differently, right, in terms of relative performance. Now, when you think about utilities, the key is to realize that oftentimes they will outperform, not because necessarily they're doing well, but because everything else around is doing poorly, right? So it's a relative argument on utilities as far as what it tells you about the stock market. Typically, in real recessions, you will see utilities do well, just like you see bonds do well. Why? Because there's an income component, they're lower beta, they're lower risk. But again, that sort of early sensitivity to changes in interest rates is really what you're trying to gather in the behavior of utilities against the market as a warning sign that maybe something's coming.
Mm-hmm. So exactly as you're saying, that they're a warning that maybe something's coming, Michael. We're coming up on almost a year of the, let's say, COVID crash here in the stock market, and pretty much all equities around investing, really. So are there any indicators right now that are informing you to change your positions in any meaningful way?
So, as we sit here mid-March, right, I mean, it's a couple of things have been happening, right? One is you've seen, to start off the year, and really since the election, I would argue in November, a kind of tectonic shift away from tech/growth into value/financials, energy materials, right? So some people viewed that as the start of a correction. I didn't view that at all at the start of a correction, because credit spreads had been fairly tight throughout this, and risk on conditions largely remained there despite these kind of air pockets around things like GameStop, which I'm sure we'll talk about. But so you've got this kind of broader rotation that's happening from growth to value. Now, having said that, it looks like some of these signals, at least short term, are starting to show some cracks in the armor, so to speak. Utilities against the broader market may be starting to bottom out, just as everyone is worried about yields rising at this unrelenting pace as far as treasuries go with this yield curve steepening. Lumber to gold may have topped out. We'll see, but that's important, because if lumber starts weakening, it would actually suggest the demand for lumber is weakening relative to gold in particular, which is more of a risk-off safe haven play. If the demand for lumber is weakening, it probably means that housing, which has been on fire, may start to weaken, and there's all kinds of implications on growth and inflation, credit creation because of that. So, it's curious to me, right? Because everyone seems to be so bulled up and thinking that with all the stimulus, you're going to have just a complete unrelenting melt up, as if we haven't already had one. Meanwhile, as all this stimulus is being dolled out, you are starting to see some defensive rotations maybe start to take place here. So, oftentimes the market does what the crowd, the opposite of what the crowd thinks it will do. right? And the narrative around reflation is very real, and I believe in it just like everybody else, but I think it's so one-sided that it wouldn't surprise me if you get some kind of counter narrative or rally in the deflationary trades, which would probably surprise a lot of people. But again, that's what markets are designed to do.
So when you say a deflationary trade, what do you mean by that?
So look, the when I think about risk on, risk off is just another way of saying inflation or deflation. That's really all it is, right? Because under what conditions are utilities weak, treasuries weak, is lumber to gold strong, reflationary hope? Under what conditions are utilities strong, treasuries strong, lumber to gold weak? All that's risk off. That will be deflationary. Let's call it deflationary reality. Mm-hmm. So the issue that I have with sort of the reflation narrative, very, very long term, is every single round of stimulus the Fed has done has actually ultimately been more deflationary than inflationary, right? Because what's happened is the inflation might be there for a moment in time. You get this kind of burst of inflation expectations, but then the debt rises at a faster pace than the inflation they're creating. So if treasuries are meant to sort of anticipate, a much longer time frame, and there's no end in sight to the acceleration of debt in the system, which is deflationary, it's hard to see how I think treasuries could just utterly collapse, too much from what they've already done. Mm-hmm. Right? Part of this was obviously justified because there were a lot of other reflationary signals, right? But the longer term secular disinflation argument, I don't think goes away no matter how much spending, stimulus, infrastructure, whatever money printing there is, right? And I think that means you're going to have more of these pulses of risk on, risk off as far as equities and treasuries. And that probably means that even within the commodity landscape, all the reflation commodities may end up taking a pause or reversing. Gold relative to commodities may benefit from that, right? Because obviously all commodities have run except really gold in the most recent period here. And again, I go back to, people forget you need, for inflation to occur, you need more debt, which is longer term deflation. And you keep playing this game back and forth of inflation, deflation. So it's hard to sort of see how any of this would be systematic in terms of what the Fed's trying to do. And that's where I think there's some interesting opportunities. Mm-hmm.
So, Michael, as you're talking about inflation, obviously, there's a lot of people that think, let's say the CPI is just a joke way of really measuring inflation. What do you think it's going to take for us to see real inflation that's not necessarily counteracted by that deflationary force pushing down on it?
Yeah, I mean, for real inflation, you need to have wage growth, right? I mean, that's always been the Fed's problem. And every single time there's an argument for wage growth, technology comes in and just counters that need to hire more people at higher salaries, right? So it's wage growth, as you can argue, is the good inflation. The bad inflation is the inflation in food and everything else that people need. So by that metric, yeah, we are in clearly an inflationary period. I mean, just given especially the way food prices have behaved, coming out of COVID. Typically, agriculture tends to move first, and everything else kind of follows as far as the commodity space goes. So, but again, I go back to I don't know how lasting that is, and it's look, this inflation deflation question and dynamic is also an issue of what does it mean for the wealth gap? What does it mean for society? What does it mean for capitalism in general, kind of from a 30,000 foot view? Because if you're going to make the argument for longer term inflation and wages are not picking up, I can promise you're going to have a lot more protests. You're going to have a lot more Marxist elements in the system because, people will want to say, well, look at how the top 1% of 1% of 1% is getting all of the money and we're suffering and unable to pay for our groceries. And I think so that I'll tell you worries me more. And when people talk about inflation as a secular trend, I think they're failing to recognize the very real dangers to the system in terms of societal upheaval, given this huge gap between rich and poor as a result of that.
So you've already kind of explained to us the lumber gold ratio and what that tells you. Are there any other relationships that you watch on when to rotate into gold?
Yeah, so the gold is it's more of a safe haven commodity, right? So gold, for a moment in time, tends to correlate to higher risk in the stock market. So no different than treasuries. Treasuries historically are actually more of a better risk off safe haven asset, but gold does have some elements there. So I think, if you're going to say, well, look, I'm going to tactically position into gold, you'd want to follow these different relationships on stock market volatility because that's where the correlation tends to historically be highest. Gold, I think, from a strategic perspective, makes sense, right? As far as being a portion of portfolio, and I'm sure you talk to a lot of analysts that make this point that diversification right now is very hard to achieve, right? Because you look at a 60-40 stock bond portfolio that's traditional, well, that's kind of sucking, right? And bonds look vulnerable. Gold may be a better sort of, diversifier than bonds, which just kind of react ultimately off of beta to some extent. And I think at the margin, that explains why there's demand for gold, probably explains why there's some demand for Bitcoin and crypto and things that are sort of non-traditional, because you don't get the same kind of diversification you once did. So I think from that standpoint, that's a big driver of probably future demand for gold beyond the sort of reflationary, tide lifting all boats, so to speak, in the commodity space.
Mm-hmm. Excellent. So is copper also signaling more of a rotation into commodities?
Yeah, I mean, look, copper, it's similar to lumber in that it's a reflationary trade, right? So lumber is about housing, copper is about industrial activity, right? So it makes sense. And I think, as these kind of rumblings about an infrastructure bill, start to get louder, I would suspect you're going to see, broader sort of upward pressure on prices there. So I look at lumber, copper more as signals. I think it's hard to make a very strong investable case, because the argument for most commodities, even though I think there is a cycle, maybe even a super cycle, is that, the cure to prices is price, right? So the higher that a commodity price goes, the more there's going to be more mining, more supply at some point, and at some point it then finds an equilibrium. But I do think that, the signs are there for this sort of, reflationary hope. But if copper is performing strongly because it's about reflation, and equities are performing strongly because of reflation, copper is not a diversifier either, right? Because it's still kind of moving off of equities as far as what that narrative really is around inflation expectations driving prices up in all risk assets.
Mm-hmm. So you and I are speaking on Wednesday, the 17th, and of course, that's the day of the FOMC meeting. So considering the recent rise in bond yields, can you tell us why it's not necessarily the rise alone that you're watching, and it's more actually the credit spreads widening at the same time?
Yeah, so I got to tell you, it drives me crazy that people kind of keep saying, "Oh, the stock market can't handle these high rates." It's just not true, right? So there are two types of rates, right? There's interest rates that are set by the Fed and what you see in treasuries, and then of course there's corporate credit risk, right? Rates in the especially corporate side and junk debt side of things. Mm-hmm. So what's interesting about this yield curve steepening that we've seen, that's with long duration treasuries selling off in price and spiking in yield, is you have not seen credit spreads widen. Credit spreads are basically sort of the difference between, let's say, high yield junk debt and risk-free treasuries. So as long as that stays tight, it suggests actually that it's not a problem, because it means default risk is not increasing as yields in the treasury market are rising. And historically, there's a very strong correlation between VIX spikes and a credit spread widening, right? So it's sort of another way of playing volatility in the stock market is just to bet against junk debt. I mean, it's just sort of a well-known intermarket relationship. So until you get to a point where yields on treasuries are high to the point where you see it impacting the differential between junk relative to nominal treasuries, I think that's where you might want to be cautious. And presumably when that happens, you would see all the signals I track in the papers, utilities, treasuries, lumber, gold will also kind of confirm the same notion, right? Everything tends to kind of act the same way in the extremes, right? As far as these relationships go. So I don't buy the rising yield narrative as sort of being negative for equities. It's felt very painful for anybody in tech, right? I mean, obviously technology has taken it most on the chin as rates have risen, which has helped and benefited financials, energy, and materials. But I'm always cautious about narratives that don't seem to make sense when you actually look at this historically. You want to see a steeper yield curve to an extent. You want to see a rates rise because it goes back to the demand for money is increasing. Mm-hmm. That's actually bullish, right? That's not. It's so funny because people got so used to sort of the idea that flattening is the bull's friend when it comes to the stock market, except that's completely not true historically.
Mm-hmm. So exactly as you're talking about rising rates here, recently you wrote that the Fed has a vested interest in trying to make sure that rates don't soar too much higher from here too fast, right? And that's the important part. So why is the speed at which rates are rising the thing that the Fed is watching most here?
Yeah, well, I mean, the issue is if it gets too out of control, that's when you would see it permeate to junk debt, and then it might be too quick of an unwind for the Fed to kind of step in before the damage is already done, right? I mean, I think that's kind of the issue. You even saw that in the midst of the COVID crash, right? As far as the Fed did a number of rounds where the market kept on going lower because they were too late to the magnitude of the problem, right? That we were seeing last year. So I think that's sort of the thing they're most paying attention to. But again, as long as that speed does not result in an equivalent widening of credit spreads, I think it's okay. The bigger problem to me, which I think is why I've been making this point on Twitter, the most responsible thing the Fed could do here is actually hike rates. Mm-hmm. Now, some people say that's crazy. I don't think it is at all, right? Because as what's happened with zero interest rates or with very low interest rates, it's caused companies to more and more invest in technology, which replaces labor. Well, if that's replacing labor and wage income is what everybody agrees is the real kind of inflation you want to see, you're not going to get wage inflation the more that technology counters hiring. Mm-hmm. So they say they want to keep rates low to reach max employment. Well, the problem is that if you keep rates low, you're going to have more and more companies invest in technology because money's free, capital's free, and that'll just replace more and more people. Now, some will argue that is a trend that's not counterable. I don't disagree, but the speed at which that happens, perversely enough, may actually be a lot slower if you hike rates mm-hmm. on and actually make the cost of capital mean something. And the more the inflation expectations rise like this, I keep going back to, it's going to create societal issues. So they have to also somewhat try to get ahead of it, rather than just say, well, listen, we view inflation as transitory. The more they say that, the more it's going to be a problem for the system. They are creating the very animal they're trying to tame, right? Mm-hmm. They're creating this debt excitement. And it's so funny. I got to tell you, Tom, it's like, I don't know why, 4 or 5 years ago, it seemed like people actually worried about debt. Now it's like nobody seems to care about, and it's not just a U.S. phenomenon. It's not even a political issue, right? The amount of debt in the system that the Fed has enabled is really problematic. The best thing the Fed could do is actually hike rates, mm-hmm. try and slow that debt issuance down to allow for some of these zombie companies to actually go away to make the system more efficient. Mm-hmm. So it's really fascinating to me where we are in a system, and I'm sure you've talked to a lot of people that talk about this great reset idea, and whether or not you want to believe it or not is who knows, right? As far as if there's a grander sort of scheme out there, but we're in a very precarious situation as a system and as a society because the Fed created those conditions.
Absolutely. So, Michael, exactly how you're saying the basically the amount of money that's out there, conditions are beginning to look ideal for banks to start loosening the purse strings on lending activity, as you wrote, as global outlook improves and yield curve steepens. So, can you tell us more about why this would lead banks to start lending more?
So it's really about the incentive. So typically, banks will lend long and borrow short. So they're trying to take advantage of the spread, what they call the net interest margin. So now banks are not as sensitive as they used to be to that because there's a lot more other revenue sources than just lending. But the more the yield curve steepens, the more incentive banks have to actually lend that money out because now they can actually make a profit. Mm-hmm. Which is also going to be problematic also at some point because then it's the banks now encouraging debt even more than the government itself through all the stimulus that they're doing with the Fed enabling and monetizing all this debt. So that's why it is true. I do believe there is a situation where the inflation part of it could get out of control, in a relatively short time frame before a longer term deflationary pulse comes in, because the Fed at some point has to counter the fact that they can't simply have a society where the very wealthy are benefiting from inflation on assets while everybody else who has to live on income is not making anything on it.
Mm. Excellent. So you were also saying that this is more of a worldwide phenomenon. So why could Australia's commitment to yield curve control quickly spill over to other central banks worldwide?
It's all about setting precedent, right? That's the way I view this, right? And we said it. You can say that in the U.S. I think it was in the 40s, right, when we had a form of yield curve control as well. The problem with yield curve control is, at least historically, it's also seen as inflationary, right? Because you're artificially making rates more negative, right, by controlling the nominal rate that's prevalent at the time. So it may actually be completely the opposite of what the Fed wants, because if they're going to try and quote unquote control yields because they're rising too quickly, well, then the so-called bond vigilantes may actually force it even further. In which case, the Fed goes from lender of last resort to the only lender, right? And I think that there's all kinds of implications that you can make a case are very negative if you get down that road. But I don't like what I'm seeing as far as that goes, right? Because if you have this sort of feeling that if they did it, we can do it too. Then how in the world can we have any kind of efficiency in any country's economic system if you just keep doing nothing but manipulate every aspect of the cost of capital?
Mm-hmm. So in your recent report, you wrote about convertible bonds. What has their performance been as of late, and what purpose do they serve in your investment toolbox?
Yeah, so I mean, the convertible bonds are not often kind of referenced to talk about. They're kind of like a hybrid of stocks and bonds. They've far outperformed since the March lows, because of that ability to be equities, right? So they kind of have this kind of unique risk return profile. I think it's an interesting thing to look at if you're in a true inflationary rising rate environment, because historically convertible bonds tend to do pretty well in that environment, which makes sense because they'll have some of the equity up capture while still having some bond characteristics relative to just having pure bonds. They actually end up being better in rising rate environments. I always like kind of focus on vehicles that most people tend to not think about or talk about because they might be overly complex, but they might end up being quite useful from a diversification standpoint. So that's not sort of me advocating for convertible bonds here, because I think at some point these rates will kind of settle down and the spike will stop. But I do think it's interesting to kind of look outside of the traditional asset classes, maybe into more hybrids, even preferreds as well, that could benefit from what may be a new regime change in the behavior of interest rates to risk assets.
Mm-hmm. So you recently tweeted about the $1.9 trillion stimulus bill and made the point that indirect stimulus to people is far less effective than direct stimulus. So why, from your view, does this bill not help people as much as it might first appear?
Yeah, so I don't understand this. So they're doing $1,400 stimulus checks. Not everybody obviously gets it, right, to individuals, but then $500 billion I think goes to large corporations, 300 plus to small. And I look at this, and I say to myself, I'm pretty sure the most effective stimulus is just giving people that need it the most those checks to actually spend. Mm-hmm. And rather than keeping a lot of these zombie companies alive, through stimulus, through their own checks. The best way to keep businesses alive is to give it to their consumers who will spend on those businesses, right? So you got this $1.9 trillion bill, but only a relatively small percentage is going to the end American, right? And I just find that very strange because every round of stimulus obviously has its own political, they call them pork, right? So there's things that really have nothing to do with why the stimulus is meant to be out there to begin with. So why are people not up in arms about the usage of stimulus, right? It kind of goes back to this issue I've always had that, the U.S. doesn't need stimulus, it needs discipline. The discipline isn't to say let people suffer. It's actually the discipline in terms of where you allocate the funds most effectively to those that actually need it, right? There are going to be a lot of people that don't need those checks. There are going to be a lot of people that get those checks, and they're going to go and speculate in the casino of the stock market and crypto and all that even furthers the casino, right? With the perception it's a casino. So I actually think it's very concerning that nobody wants to question. So some people will say, well, it's they read the stimulus bill in Congress. Okay, first of all, it's a 590-page bill, and I'm pretty sure nobody's attention span was high enough to really kind of dissect every single sentence and every single word. And I think this is again, it goes back to this is what the Fed has enabled. It's created sort of this continuous money printing. The potential to basically have so much money that is spent inefficiently, it lines people's pockets and makes the wealthy only wealthier. And we're talking about this before. I'll make the case very, very loudly. I think the Fed is bringing out the worst in humanity in this, because it's preventing the right type of actions to be taken for those that actually need that capital. It's resulting in politicians through lobbyists getting their own pockets filled because there's so much easy money out there. And it's making it's creating these kind of echo chambers of a narrative of the little guy against everybody else, right? The us versus them narrative that you see with Reddit, that you see in the Bitcoin community, because they have been left out for so long. And now it's like, well, you know what, give me free money and I'm going to just do what I want and education be damned. I'm just going to speculate. I really am sincere when I say this. I mean, the fabric of society, I think, is at risk here with the way that nobody seems to care about the consequences of all this easy money. It makes people even more set in their ways and their viewpoints. You can't even have a conversation now about investing. It ends up just being, well, it's going to be a bunch of meme stocks and, a bunch of making fun of people who are, went through formal education in the business of finance and investing, instead of sort of, an actual real discussion around where are we in the society? Do we want to keep on doing this to ourselves?
Mm-hmm. And exactly as you mentioned that, Michael, there's this us versus them mentality. And of course, we've really seen that develop with GameStop and even the silver squeeze to some extent. So what might have been some of the consequences, let's say, that people weren't maybe thinking through completely when they were really going after these systems?
Well, it's that, when you have this much debt in the system, it doesn't take that many butterflies flapping their wings to create a hurricane, right? So to me, the lesson of GameStop, which it should scare everybody, but seemingly nobody thinks this way. You had a moment there where one stupid stock, I'm sorry to say it that way, but one stupid, silly stock where you had a bunch of people doing memes and, God bless them. They identified an opportunity and they went after it with the high short interest, but it actually created for a moment in time systemic risk with Robinhood. I mean, think about that for a second. It's all fun and games until suddenly it might be another 2008, right? So there's always unintended consequences to these types of things. And I'm not saying that that's something that's caused by the Reddit community, but there's always secondary and tertiary effects with anything that happens in markets. They butterflies flapping, and people don't realize that it can actually be to their detriment. I'll tell you kind of a corollary to that. I remember in 2008, there were a lot of people that were very bearish on banks, right? And Credit Suisse in particular, which was one of the counterparties to the VIX ETN or ETN, right? The exchange traded note. And a lot of people were betting on VXX, saying, I'm going to buy volatility because all the banks are going to crash and Credit Suisse is no longer going to be in existence. Yet Credit Suisse was a counterparty to the very product they were using to make that bet. And I remember I was talking to people saying, you realize that if the entire financial system goes, your bet on VXX volatility as an exchange traded note would actually be worthless because the counterparty is worthless, right? But nobody thinks in terms of those links, right? And I think that's where, again, as a society, we're in a really dangerous spot. You can see that with the speculation going on with call buying, and it's all fun and games until there's something much more serious that all of this manic trading creates risks around, which again is all enabled by the Federal Reserve. Mm-hmm. So there's a lot more risk out there than people realize. And I have an incentive to talk about risk on, risk off because I benefit from market paths where those types of swings occur. That's where my mutual fund and my ETF tend to historically thrive. But I just worry about the way things are occurring, and this is how you end up having sort of a rise of Marxist elements, and how you have a sort of a rise of give me free money and old discipline and hard work be damned.
Mm-hmm. Yeah, and that just kind of goes back to the point that there's just really too much leverage in the system, right? Yeah,
and too much cronyism, mm-hmm. right? Which again, I would argue the Fed has enabled. Look, you cannot. Everything is a consequence of the wealth gap, right? Everyone's equity chambers is because of complete disgust around the wealth being concentrated around just a very small percentage of the population. Now, you can make the case, and I think that's accurate, that the wealth gap can never fully be closed. It's true, but you also can't let the wealth gap get too wide, mm-hmm. because the wider the wealth gap gets, the more the quote unquote proletariat start to rise up, right? So and that again, that has to do with this discussion around assets benefiting from low rates versus income, right? That don't benefit at all, obviously, from low rates. Mm-hmm. So there has to be some degree of a counterbalance. Now, you can't really do that with policy because even if you're going to tax the very wealthy, okay, they'll go to some other jurisdiction or country, okay, or they'll buy Bitcoin and hide it, which I suspect is probably happening in other countries as well. So how else do you do it? The only way to do it is, I think, realistically, just give people direct checks that need it the most, try to balance a little bit better, and get rid of all this other nonsense of spending on things that don't actually impact people's lives.
Mm-hmm. So, Michael, I'd also like to get your thoughts on scarcity and liquidity and how you apply that framework to different asset classes.
Yeah, so the one of the arguments for Bitcoin is that it's scarce, right? And you always hear that term about scarce. And I'm not bearish on Bitcoin, but I do believe you have to poke holes at every investment narrative. So I had this day in there a couple of weeks ago on Twitter where I was basically saying, it can't really be a scarce asset if you can keep on dividing it as the value goes up. Some people say, what do you mean? There's only a set number of Bitcoins. You don't know math, right? That's one of the counters. The definition of scarcity is hard to find, right? So as an actual definition, scarcity implies there's an illiquidity aspect to what is scarce. Bitcoin is not scarce from that perspective. You can find it. Maybe you can argue gold and hard commodities are scarce, right? Because you can only divide it up to an atom, right? Conceivably. And you got Satoshis as far as the sort of denomination for Bitcoin, but even that's, I think, debatable as to how that plays out longer term. So finite just definitionally is different than scarce. And I think my whole contention with Bitcoin is that it's not a scarce asset. It's not a store of value either because it's too volatile. You can argue it's an emerging store of value. Okay, I can maybe buy that argument. To me, Bitcoin is an investment. Now, the reason I think semantics matter when it comes to any investment, whether it's Bitcoin or anything else, is you've got to know why you're buying what you're buying, right? So if you're going to argue, for example, that Bitcoin or any other sort of NFT, now is sort of the rage, that these are stores of value, that implies that you could be 100% in those stores of value and not lose money in the event that you happen to need it because of an uncertain cataclysmic event that happens in your own life when you need that liquidity. If it's not a store of value and it's an investment, you know that there's risk and you size it appropriately. If it's a store of value, you go all in, right? So it's a question of waiting. So
Michael, just to interrupt you for a second, as you said, semantics are important. So could you maybe separate that from being an investment to being also maybe more accurately a speculation?
Yeah, no, I think that's exactly right. And the thing is, I think, there are a lot of studies that show that, when somebody invests in something, their belief in that thing goes only higher just because they own it. Right? So you have to always be careful, right? Because you don't want to speculate your entire portfolio because the risk of loss or the risk of a cataclysmic loss, right, ends up being very high, right? If you're viewing something as an investment, you size it appropriately as a lower amount of your portfolio. If you view it as a store of value, it shouldn't be anything that you will ever have to touch, right, in terms of liquidity, and it should be something that is not volatile. So again, I go back to semantics really are more about waiting, right? If you're going to speculate, you want to probably speculate with a low amount of money because the speculation could go down to zero. If you're going to invest, you want to be diversified against other investments. If you're going to be a store of value, then you've got to be largely all in, and I don't think it's a store of value. I don't think there are many stores of value, by the way, in anything because the Fed eliminated the idea of a store of value the moment that they went to a zero interest rate policy, right? Because cost of capital means nothing when you have rates that low, right? So, for me, it's wording matters when it comes to thinking about investing. I am a fan of, because I'm so against fiat, I'm a fan of what Bitcoin is trying to accomplish. I'm not a fan of the narratives and the echo chambers that people are putting themselves in how they think about it when what they're saying, you can just ask a few questions, doesn't make any sense.
And that goes back to your saying of that when an investment becomes a religion, it's time to lose faith, right?
Yeah, no, and I use that line on Twitter at Lead Lagger for quite a bit, but I really do believe that, right? And it's, look, the issue for me is I come from a very simple place. I don't believe anybody can predict the future. Simple as that. And the only thing you can, however, bet on is if everybody thinks they can predict the future, well, now the payout is higher betting against the crowd, right? So really, when I kind of think about contrarianism, it's not about a forecast. It's about saying, well, if everybody's convinced of some future path, well, then I could be totally wrong in being a contrarian betting against that, but I know that the payout is a lot higher betting against that because fewer other people are thinking the same way, right? As me as a contrarian, right? So I view it more sort of in terms of like an expected value type of equation, right? Probability times outcome rather than what I think the outcome will be. So, and that goes back to the Fed bringing out the worst in humanity because with all of this money and everything going up the way it's going up, it's reinforcing everybody's belief that they know the future simply because the Fed is creating, at least in the short term. Right? So, and I think that's problematic.
Michael, I want to push back a little bit on something you said about when the Fed took rates to zero and basically removed the cost of capital. How do you think about gold not being a store of value in that case?
So again, to me, it's more about the volatility dynamics, right? So, and that's why I say I would even argue that gold, and some people will not like me saying this, but I would even argue that gold, has not been a store of value in the most recent period. Obviously, it was in many, many other cycles and junctures. Mm-hmm. And store of value, again, I think implies that you will not lose money and also not gain money. You will keep up with whatever personal rate of inflation there is, because that's what the value would kind of keep up with. Mm-hmm. So gold obviously hasn't done that, right? Gold hasn't done very much for several years here. From that standpoint, it is not a guaranteed store of value. Now, of course, you look over a longer period of 40, 50, 60, 70 years, even 100 plus, that you can make a case unequivocally, right? But I think, and again, maybe the semantics, but I think if you're going to argue that a store of value only is that a particular asset is a store of value only in certain cycles, it can't be a store of value.
Mm-hmm. Excellent. So do you see anything being a store of value in that case?
No, I mean, and that's you can argue that CDs, certain deposits were quote unquote stores of value when you actually had rates that were higher, 10, 15 years ago. And it's interesting. There's a lot of studies on how CDs were actually a better proxy for store of value and income than bonds, right? Because it was sort of a guaranteed rate of return, and oftentimes it was low enough that it was kind of more in line with inflation. So I don't think you have any of that, and that's the issue the Fed has created, right? As we know, they've resulted. It's what's happened with all this money printing is it's created more and more risk taking, which in that risk taking makes everything risky, right? Because the money has to flow to something, right? So everything is either is on the edge of investment or speculation at this point.
Interesting, Michael. Well, that was a really awesome, wide-ranging conversation. Do you have any thoughts you'd like to add as we wrap up here?
No, look, I mean, I think the biggest thing is diversification of strategies will matter more than asset class. And I think if you think that this is going to be a smooth market going forward, I have another $30 trillion of money to lend you from the U.S. government. This is very tricky, folks. I mean, this is, aside from what I think is real societal risk here with the ever widening wealth gap, there's a real issue here as far as this debt. And I've been saying this before Biden. I was saying this under the Trump administration. Both political parties in the U.S. suck at being fiduciaries of taxpayer money. To simple that. Mm-hmm. And I just worry that we're getting to a point where really something bad could happen, right? Just in terms of the fabric of society. You never heard about MMT, modern monetary theory, up until recently. It's becoming more and more mainstream because it's like, well, I guess that doesn't matter. So, you're telling me there's no consequences to all this money printing, to all this stimulus money that doesn't go to the actual consumer, And from an investable standpoint, that doesn't mean you go short. It just means you've got to manage your own expectations and have as much exposure to as many possible uncertain paths as possible, which means gold, which means probably Bitcoin, it means equities, it means maybe even my own funds, right? It means you've got to just have as much diversification beyond an asset class because you don't know when. And the reality is we don't choose the cards we're dealt, just choose to play the game.
Excellent, Michael. Tell our listeners where we can find more about the Lead Lag Report.
Yeah, no, I appreciate that. So if you can sign up for a 2-week free trial at leadlagreport.com. And again, I'm more than just a researcher. I run the ATAC Rotation Mutual Fund as well as RORO, the ETF I launched November of last year. You can find info at atacfunds.com. And I do everything I can on Twitter to interact. And some people find it controversial, some don't. But I do my best to at least be honest and real.
Mm-hmm. And of course, that's at Lead Lag Report. Michael, thanks so much for your time today. Really appreciate it.
No, thank you, Tom. Appreciate it.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.